First, let's define what a stock market crash is. Simply put, a stock market crash is a sudden and dramatic decline in stock prices across a significant portion of a stock market, resulting in a substantial loss of paper wealth. Crashes can be triggered by a variety of factors, including economic crises, catastrophic events, or the collapse of long-term speculative bubbles. There have been several notable stock market crashes in history. The most famous of all is the Great Crash of 1929, which marked the onset of the Great Depression. Another significant crash happened on Black Monday, October 19, 1987, when stock markets around the world crashed, shedding huge values in a very short time. There are generally three main causes of stock market crashes. Economic factors. These include economic recessions, rising unemployment rates, or skyrocketing inflation. When investors lose confidence in the economy, they tend to sell off their stocks en masse. Psychological factors. Panic selling and herd behavior play massive roles in crashes. As more people begin to sell, prices drop, prompting more people to sell. A vicious cycle. Financial instability. Weaknesses within financial institutions and markets themselves, such as excessive leverage or speculative bubbles, can precipitate crashes. For example, the 2008 financial crisis was primarily due to the collapse of the housing bubble and risky financial derivatives. The aftermath of a crash is typically severe, often leading to a bear market, recession, or even depression. Entire economies can be affected, businesses suffer, jobs are lost, and consumer and investor confidence takes a hit. Governments and central banks usually intervene to stabilize the economy, employing measures such as monetary easing or fiscal stimulus. One of the key takeaways from studying stock market crashes is the importance of diversification. Spreading investments across various asset classes can mitigate losses. Understanding market fundamentals rather than following speculative trends can shield investors from the worst impacts. By learning from past crashes, investors can better prepare for future market upheavals. In summary, stock market crashes are sharp declines in market prices triggered by various factors like economic downturns and investor panic. Their impacts are far-reaching, affecting both the economy and individual livelihoods. By learning from past crashes, investors can better prepare for future market upheavals.